Mortgage market analysts are closely monitoring the potential impact of the Iran war on mortgage rates. The conflict and the risk of sustained oil supply disruptions from the region have already influenced the 10-year constant maturity Treasury rate, a key benchmark that affects both traditional mortgage rates and the expected rate, which is used in the home equity conversion mortgage program. We're going to get into all the details. We'll do that right after this short message from our sponsor.
Liberty Reverse wants to help you grow your reverse mortgage business with our proprietary Equity IQ product suite. Equity IQ gives your borrowers access to more funds, lowers their upfront costs, and expands eligibility for home purchases. Learn more at partners.libertyreversemortgage.com today. This ad is intended for mortgage professionals only and is not a consumer solicitation. PHH Mortgage, doing business as Liberty Reverse Mortgage, is an equal housing lender. NMLS number 2726.
Welcome and thank you for joining us. For most Americans, Treasury yields may sound like an obscure financial statistic, but in both traditional and reverse mortgage lending, the 10-year Treasury rate plays a direct role in determining a homebuyer's purchasing power and how much home equity a borrower can access through a federally insured HECM loan. Housing Wire analyst Logan Matashami notes that while several housing demand indicators have improved in recent months, the biggest risk to the market remains rising Treasury yields driven by inflation pressures and global instability. Since the conflict began on March 1st, the bond market has been reacting to two competing forces. The first is inflation. Whenever geopolitical conflict erupts in the Middle East, energy markets immediately become a major focus. Oil prices often rise as markets begin pricing in the possibility of sustained supply disruptions. One reason markets react so quickly to conflict in the region is the strategic importance of the Strait of Hormuz. Roughly 20% of the world's oil supply moves through that narrow shipping corridor each day. So even the threat of disruption can quickly ripple through global energy markets. Higher oil prices tend to push inflation expectations higher, and when investors anticipate higher inflation, they demand higher yields to hold long-term government bonds, such as the 10-year Treasury. And that is exactly what we saw in the early days of the conflict. Treasury yields moved higher as markets reacted to rising oil prices and the possibility that inflation could remain elevated. But then something interesting happened. As geopolitical risk came into clearer focus, investors began doing something that has occurred repeatedly throughout periods of global instability. They moved capital into U.S. Treasuries. U.S. Treasuries are widely considered one of the safest assets in the global financial system. During times of uncertainty, investors often buy them as a hedge, and that purchasing power pushes the bond prices higher, which in turn pushes the yield lower. So after the initial rise, the 10-year Treasury yield began to retreat slightly as demand for safe haven assets returned to the market. According to analysts at Charles Schwab, the bond market is currently caught between two competing reactions. First is inflation fears from rising oil prices, and they're pushing yields higher, while geopolitical uncertainty simultaneously is driving investors into U.S. Treasuries as a defensive move. The reaction has already begun to show up in the mortgage markets. As reported by ABC News, mortgage rates recently moved back above 6% as the conflict in Iran rattled bond markets and revived inflation concerns. The average 30-year mortgage rate climbed back above the threshold of 6% as investors reacted to the possibility that higher oil prices would keep inflation sticky. Then there may also be broader implications for monetary policy. According to reporting from Reuters, some economists now believe the conflict could delay potential Federal Reserve cuts later this year if energy prices fuel inflation. For you as a reverse mortgage professional, these developments, they matter more than they may initially appear on the evening news. Movements in the 10-year Treasury can ripple directly into the amount of equity that's available for borrowers through the HECM program. But the broader lesson here is that events which appear completely unrelated to housing finance, they can still influence reverse mortgage outcomes. Wars, energy markets, inflation expectations, and global capital flows, they all shape the bond market and influence Treasury yields. So while the headlines may be focusing on oil prices or geopolitical conflict, mortgage professionals are closely watching the benchmark that often matters most, the 10-year Treasury. Because when that number moves, it can quietly change both homebuyer purchasing power and how much equity American seniors can unlock from their homes. In the end, these forces shaping reverse mortgage proceeds are not always found in housing policy or underwriting guidelines. Sometimes they begin thousands of miles away in global energy markets and the bond market that ultimately prices the cost of money. What are your thoughts? You can leave those in the comment section below. Also, if you would share this video on LinkedIn, we always appreciate that. We have a YouTube channel. Be sure to click on the subscribe button. That way you never miss out on any of our latest content. And each and every week, you can catch up on the latest reverse mortgage news and our weekly podcast, Heck'em World Weekly. We have both an audio and video edition. Listeners can listen and subscribe on Apple Music and also on Spotify. Thanks again for joining us, and be sure to return next Monday for more reverse mortgage news, commentary, yes, and you know it, and analysis you only find here at Heck'em World. Have a great week.